Okay. Thanks to the organizers for including us. This is a paper that got started when I was visiting Norges Bank with and Paolo and Gisle are two of my former colleagues, and Gisle has since moved on to BI. So let me put up this picture to kind of motivate what we're doing. I hope you can see this, but what we have here is all of this is quarterly data going back to 1960. And the red lines are the sample means for all of these things. And so here we have household real estate value. So you can think of that as price times quantity from the flow of funds divided by personal disposable income. So kind of a valuation measure for housing, price to income ratio you can think of it as. Household mortgage debt to income, so that's kind of a leverage ratio. Quarterly housing rent to quarterly income. So this is kind of a measure of the dividend service flow, kind of telling you what's going on with that. And then consumption to income. And so so you can see like all of these variables were pretty much around their long run means around the mid 90s. Okay, and so that's going to be our starting, when we simulate our model, we're going to basically calibrate it so that the steady state of the ergodic mean is going to be, where these variables were in 1995. And then, the boom bust episode that we're going to try to replicate is going to be from mid-90s until the end of the sample, which in this case is the end of 2012. You can see with the real estate value to income, it had a big run up, peaked in about at the end of 2005, and then now it's in 2012 it's back to its long run mean. Mortgage debt similarly had a big run up. Actually, it peaked a little bit later, about 2 years later, not back to its long run mean at the end of 2012. It has a hump-shaped pattern in consumption. So we have three variables here. We're going to call boom-bust episodes. But this one you can think, and should be the tip-off that you might want to think that some of this is being driven by non-fundamentals because rent, of course, is the dividend for housing services. And that's basically if you think of this as an asset pricing type environment, then you would want to. If you thought it was a fundamental-driven episode, then you would want to see some movements in the rents, which you don't. In fact, they're going down relative to income, if anything. And so the other thing I'd like you to notice is that, okay, so like here, suppose you're an agent standing in 1995. You haven't seen this boom-bust episode yet, but looking back on the data, you see this drifting up of this valuation ratio. You see the drifting up of the leverage ratio. And you might think an agent standing there might be inclined to think, some kind of a unit root type forecasting algorithm might be useful. And, we're going to incorporate that in our model. Okay, so this idea of rational explanations of the boom often appeal to exogenous housing demand shocks, and you see that in a lot of these DSG models. But the problem with that story, of course, is that that increase in the housing service flow should show up in the rents, and you don't see that in the data. And so then that suggests that maybe we should think about other types of explanations. There's a lot of evidence. I'll talk a little bit about this with regard to lending standards. The empirical evidence on that, I think, is pretty convincing. And what we're going to do here is we're going to write down a very simple asset pricing model for housing. We're going to allow 4 types of shocks and how they can account for and see how well, what pattern for those shocks are necessary to make the model fit those pictures I just showed you. And then we're going to, it turns out we're going to look at 4 different versions of the model depending on how agents form their expectations and the type of mortgage contract that exists, whether it's one-period mortgages, which is what people typically use, or long-term mortgages. And we're going to find that a model with moving average forecast rules or adaptive expectations and long-term mortgages does best in fitting the data, in the sense that it can match the data without resorting to these big housing preference shocks, which are problematic because of that story about the rents. And it generates what we think are a plausible story about lending standards. Okay, so this is a partial list of the literature. I apologize if I've left anyone off. But anyways, there's a lot of research to try to explain what happened and why. Of course, John Taylor says it was the Fed's fault. Interest rates too low for too long. Again, this is just a sampling of the lot of empirical literature on that, which really puts a lot of blame on just collapsing lending standards, et cetera, imprudent behavior on the part of the banks. And some people have incorporated that into models. There's DSG model work that uses the housing preference shock story. There's this story about saving glut. which actually works through interest rates. So it's really kind of related to Taylor's story ultimately. And then, of course, departures from rational expectations, which you might think of just like kind of a bubble. So we're going to have a model that has a lot of these different elements and say what you need to kind of match those pictures. So here's a picture which I found, which I think kind of like lends itself to the idea that, yeah, well, lending standards were certainly involved in some way. And so what this is plotting is in 2005, year-over-year price growth in all the 50 states. And then in that state, the interest-only share of subprime originations, which is like, you can think of it as a measure of the degree of exoticness of the mortgages that were being issued. And these are kind of like the worst of the worst in terms of ultimately what happened in terms of their delinquency and foreclosures. Unfortunately, California was the leader in this area. But you can see that there's a positive correlation, and it's kind of like a chicken and egg problem in the sense that the lax lending standards encouraged more subprime borrowers to enter the market, bid up housing, and then the lending industry, realizing that people needed some kind of way of affording the monthly payment as prices rose, came up with these even more exotic mortgages. So this kind of self-reinforcing feedback effect. So what were they thinking? What were these lenders thinking? Okay, and so I think this is kind of a helpful way. This is an influential policymaker at the time, April 2005. This is kind of captures the mentality. Financial service sector has been dramatically transformed by technology, where once more marginal applicants would have simply been denied credit. Lenders are now able to quite efficiently judge the risk posed by applicants and price that risk appropriately. And these technology improvements have led to rapid growth in subprime mortgage lending. So this is like the classic "this time is different" type statement, right? And of course things didn't work out so well. But the banks and policymakers were looking at this kind of data at the time, declining mortgage delinquency rates, suggesting that, oh yeah, maybe this is this new era in credit risk modeling. We've got to figure it out. But of course, now in retrospect, we know what was going on is that since prices were rising rapidly, anytime anybody got into problems with their mortgages, they could sell their house or refinance. But then once prices stopped rising, which happened toward the end of 2005, then that mechanism no longer worked, and you can see this dramatic pickup in delinquency rates, particularly in the subprime area. So this is now I'm going to try to motivate we're going to introduce a particular type of expectation forecasting rules into the model. And so this is data, this is from Schiller's paper, K. Schiller Thompson. And he's been looking at the surveys of housing in different cities going back to 2002. And so what's being plotted here, there's 4 cities. There's Alameda, Los Angeles, Boston, and Milwaukee. And so in each one of these cities, this line here, which is on the right axis, is he's plotting the K. Schiller San Francisco house price index and the U.S. house price index. So that's in levels of the index, housing. So that's the thing about housing price trajectory. And then the bars are the survey responses when you send out a survey saying, what do you think house price growth is going to be over the next year? Okay, and so for example, so as house prices were rising, from 2003 to say 2005, you can see this ratcheting up in the response rates in terms of people's expectations of future price growth. Okay, and this is something that Klaus touched on. It's like you can see where are people the most optimistic in terms of future returns on housing or future price gains. It's after a huge run-up, and at the peak of the market, that's when they're the most optimistic. So this is exactly the opposite pattern that is predicted by, say, rationally time-varying risk premium, like a Campbell-Cochran habit formation model. In those models, the reason why prices are high is because people became less risk averse, and so at the top of the market, they have low risk aversion, and therefore they're only going to be compensated with a low return going forward. So that's the story in those models, which is exactly opposite of what you would see here. So they should have low returns at this point. Instead, in the data, they have high returns. And this pattern you also see with stock market surveys. And so take that same data from all those 4 cities, you put it on a scatter plot, and this is plotting the expected one-year house price change from the data, from the surveys, versus what actually happened in that city over the last 12 months. And you can see the fit's pretty good. And so what's suggesting is that the way people forecast about what's going to happen in the future is they put a lot of weight on what happened in the most recent past. And we're going to incorporate that feature into our model. So here's the model. It's a very simple Lucas-type asset pricing model for housing. So that it's the utility function is linear in consumption, but that utility is augmented by this housing service flow, which can be variable depending on a shock. And so there's going to be 4 shocks in this model. There's the housing preference shock or housing demand shock. So they can consume, they purchase housing services. This is their debt payments, which consists of interest. So this is the gross interest rate, and so R minus 1 is the net. This is the amount of principal they're paying back in that period. So this is their debt service. They have an endowment income, and then they have the housing service that they purchased in the prior period, and then new borrowing. Okay, so the new borrowing, okay, is this is in order to allow for long-term debt, we're going to assume that stock of debt evolves according to this, sort of like a capital accumulation equation. You think of delta as being this depreciation rate. It's the amortization rate on the loan, and so when delta is 1, that's when you get these, the typical setup was where all mortgage debt is 1 period and it's refinanced every single period. And when delta is less than 1, then you have what we're going to call long-term mortgages. And then I'll get to this equation in a second. But then we're going to have a collateral constraint, which says that the amount of new loans that the household can take out is going to be dependent on how much equity they're going to bring into the next period. So the bank is going to take a look at, okay, well, here's how much we expect your house to be worth going into the next period. This is how much if the bank grants them the loan, this is how much debt they'll walk out the door with. And then some fraction of that they're going to be allowed to borrow, and that's going to determine the size of the new loan. And when delta equals 1, this basically collapses to the setup where the stock of debt that you take into the next period is just some constant m times your expected housing value, because every period you pay off the loan. And then this kind of complicated looking equation here is the amortization rate law of motion, which we're going to borrow from a paper I'll talk about in a second, which basically tries to capture what you see with a standard 30-year mortgage amortization schedule, and the fact that the payments are constant, but the fraction of payment that constitutes principal and interest changes over the loan's lifetime. So at the beginning when you first take out the loan and the stock of debt are the same, so this piece is gone, and so this collapses to the very small amortization rate, because most of your payment is interest at the beginning. And then later, if you don't take out any more debt, then this term takes over, and then this delta term grows over time, which is the amortization rate actually increases. And that's how these parameters are calibrated to match a 30-year mortgage schedule. And I'll show you that. That's right here. So we're basically borrowing it directly from this paper by Kidlin, Rupert, and Sustek, where they came up with this approximation. So the payments on the mortgage, which are coming out of this model, are here, and that's what a standard amortization schedule is: constant payments every month, and then the share of interest payments goes down over time. The share of principal goes up. And so that's kind of how those parameters are calibrated. So, and as I mentioned, we're going to have 4 stochastic shocks. We have the housing demand shock. We have this lending standard shock, which again governs how much of your home equity you can extract in the form of new loans. The income is exogenous here, so an income growth is going to follow this AR1. And then we're going to allow the real quarterly mortgage interest rate to also be stochastic. So the first order condition that comes out of this model, we have the stock of housing is fixed here in equilibrium. So this is what the first order condition ends up looking like. And it's very standard asset pricing equation. So the price of housing services constitutes, there's a dividend, which has 2 parts. One is the service flow, which is influenced by that preference shock. And then there's this other piece, which is the marginal collateral value of the house, because you can use your equity to borrow, and so that's part of the dividend. And then you also have tomorrow's expected price. Yeah.
Is it a representative agent?
Yeah.
Who does the agent borrow from?
This is basically it's open economy model. So it's basically borrowing from China essentially. You can think of it that way. There's no saver borrower like you would have in some other types of models. Yeah. So the borrowing is coming from outside the United States essentially.
But you don't have those models, so they just come from somewhere.
Yeah, I mean, it's an open economy model is one way to think about it. You know, there's this big pool of that exterior savings that is providing the funds for the borrowing. Yeah. So okay. Yeah. So getting back to this piece, so it turns out that the quantitative element that's important for the fluctuations in the rent turns out to be this piece here. This really doesn't contribute a lot to the volatility of the rent because the Lagrange multiplier on the borrowing constraint, which is what this is actually quantitatively small in steady state, and it doesn't really move around that much. And so this piece doesn't really contribute a lot to the volatility of rent. It's really governed by this piece. Okay, so this is where we're going to allow for try to capture some of that features of the survey data that I showed you. And so this is we call it moving average forecast rules. It's like adaptive expectations essentially. And so this is Klaus mentioned this though. So this is a forecast rule. So I should mention there's basically 4 objects that the agent has to forecast in this model. They have to forecast the price next period, and we're gonna normalize everything so it's stationary. So when we solve the model, it's this normalized price. They're going to have to forecast the mortgage interest rate, and then they're going to have to forecast 2 Lagrange multipliers. So every one of those objects they have to forecast, we're just going to assume they use this exponentially weighted moving average of past values, and lambda is the weight on the most recent value. And so when lambda is 1, then you've got this random walk forecast. And I want to now so then how would you pin down this lambda now? With the Muth problem, basically what lambda is pinned down by the signal to noise ratio because the agent is viewing this object as being a random walk plus noise, and so the variance of the permanent versus temporary shocks is going to govern what the optimal value of lambda is in order to minimize the root mean squared forecast error. So we're going to pick lambda in such a way that if agents in the U.S. economy had actually been using this forecast rule during, as they entered the boom, this would be close to optimal. So that's what. Let me just jump to that here. So what this is, okay, there's actually, as I mentioned, there's 4 objects the agent has to forecast. 2 of them are observable in the data. The other 2 are Lagrange multipliers. So the 2 that we can observe in the data are this normalized house price and the real mortgage interest rate. And so with the red line, so what we're plotting here is the 1 quarter ahead root mean squared percentage forecast error that you would have achieved if you'd used this forecast rule in the data and for different values of lambda. So this is for the pre-boom period going back to 1960 is the red, and then the boom-bust period is the blue. And so you can see, it's kind of flat here at the bottom, and basically a random walk forecast is pretty close to being optimal for the pre-boom period. During the boom-bust period, actually, you would want to use a lambda, at least for house price, the normalized house price, you want to use something even above 1, which you just put a lot of weight on that most recent observation, but that's because the growth rate of house prices was accelerating during the boom and also during the bust, decelerating during the bust. But we're going to use lambda equals 9, which is, as you can see, is near optimal in the sense that it's near the bottom here. As you get higher levels of lambda above 1, actually create problems for the model in terms of stability. So we're not going to use that. Okay, and then we calibrate the shocks. Now, we're going to calibrate the shocks in the 2 different. Again, there's 2 different types of expectations. There's rational expectations and these moving average expectations. And so you can see the calibration in order to match the standard deviation of housing valued income in the data over this period is going to be really big in the rational expectations model. It's about 8 times bigger than what you need in the moving average model. So then that's going to create problems when you simulate that model because it's going to make the rent to income ratio really volatile, unlike what we saw in the data. And then let me just go back to the other calibration, which, again, remember we have 4 different types of models here in terms of we have rational expectations, moving average forecast rules, 1-period mortgage loans, and long-term mortgage. And the M that you need has to be changed, which is the lending standard, the steady state value of the lending standard variable has to be different in order to match the steady state debt to value ratio. Because in one case, the new loan is equal to the stock of debt, and in the other case, the new loan is just a tiny fraction of the stock of debt. So that's why this M has to be so different between the 2 models. but the thing that's in the data you want to match is the same. Okay, so now this is a simulation. Again, I'm going to get to the, trying to match the actual trajectories of housing prices and mortgage debt in the data. But this is just a simulation to show you kind of what the behavior of the model is. Okay, this is a rational expectations model. And what we're just comparing is the long-term mortgage model and the one-period mortgage model. So all these pictures of the rational expectations model. And you can get a pretty volatile housing value to income series because, again, that preference shock is calibrated to match what we see in the data. And then you can also match the standard deviation of mortgage debt to income. What you can see is that the one-period mortgage model has a lot more volatility in the debt-to-income ratio. And that's because when the shock hits, it affects the entire stock of mortgage debt, which is, that's very unrealistic that the entire stock of mortgage debt in the U.S. economy would be able to react to a shock, because not everybody refinances every period. But with the long-term mortgage, it's only the fraction of new loans. The flow of new loans is the only thing that can react to the shock, and so it's much smoother. And similarly, the consumption-to-income ratio in the one-period mortgage model is also very volatile because, again, it's responding to this shifts in the debt-to-income ratio. But then here's the picture that we want to emphasize is that you can see because of the fact that you have this you need this really big volatility of the housing preference shock to match the data in terms of this picture, that housing rent to income moves around a lot, which is going to be a problem in terms of matching the data. And then here's that same experiment with the moving average forecast rules. You can see, just look down here, you can see the difference in terms of the, because the shock that you need to match the volatility of house prices is much lower, you don't need, the implications for the rent-income ratio are much more realistic in terms of you don't see a lot more volatility there. But the other features are also similar in terms of the difference between the one-period mortgage versus the long-term mortgage. Okay, so this is now just to illustrate this idea that the introduction of these moving average forecast rules, just like in some of the other papers we've seen, when you start introducing these different types of forecasting rules that depart from rational expectations, you get excess volatility. And that's exactly what we have here. So now we're going to hit all these models with the same shock innovation, and then look at what happens to, in this case, the housing value to income, and then mortgage debt to income. So the blue and the gray, so this is the moving average forecast rule. So this is you can think of this as the excess volatility over and above what you see in the rational expectations model. Okay, and so you can think of this as perhaps like a bubble component because there's a fundamental shock, but the movement in housing value goes beyond what the rational expectations model would say should happen. And similarly with debt, because of the fact that the collateral constraints operating here, more housing value allows for more borrowing, and then you get a higher increase in debt. And the interesting thing is you can see now the long-term mortgage, which is the blue, which is going to be our preferred model, the peak in housing value comes before the peak in debt because it takes a long time for the flow of new loans to add to the stock of mortgage debt. And so that's a feature that we saw in the data, that the housing peak happened before the mortgage debt peak. And then this is the same experiment where we hit it with a lending standard shock. Again, there's this excess volatility in the models with these moving average forecast rules over and above what you see in the rational expectations model. So this is, again, like a bubble component to the asset price. But then you can see in the lending standard shock, the one-period mortgage models, they can immediately react, so debt jumps up a lot. Whereas with the long-term mortgages, it's much more gradual and pronounced and longer. Okay, so now that's kind of just to illustrate how the models work. So now this is really what we want to do is we want to take this model and we want to reverse engineer the shocks so that we can see and so that we can match the patterns we saw in the data exactly with regard to housing value to income and mortgage debt to income. And then look at the implications for some other variables such as the rent to income and consumption income. And what we're going to do is we have the log linear decision rules. We calibrate things to match the steady state. So the steady state is at 1995 Q1. We're going to take those log linear decision rules. We have data on U.S. per capita income growth. We're going to feed that into the model, and so that's one of the exogenous shocks. Okay. The other exogenous shock is the real quarterly mortgage interest rate. So we have data on that as well. So we'll feed that into the model. we're going to smooth them a bit. I'll show you how we do that. Then we use the log linear decision rules coming out of the model under all the 4 different versions of the model, and we in first difference form, which is done because we can kill off some of the constants that are going to not, we can't match all the levels of these variables. Once we've got, so we take this, we plug the time series from the data into the left-hand side of the decision rules, and then we can back out the shock sequences to actually match the trajectories that in the data. So we have basically every single period, we have 2 equations and 2 unknowns for each model. So again, this is what we're going to, so again, we're going to match this pattern exactly, we're going to match this pattern exactly, and then we're going to look at what are the implications for rent to income and consumption to income under 4 different versions of the model. And here's the inputs, the reverse engineering exercise that I mentioned. So again, this is quarterly real per capita disposable income growth. You can see how volatile it is. This is quarterly income growth is influenced a lot by things like stimulus checks being sent out during the crisis and things like that. And so in order to kind of smooth out the volatility of that series, this is the input of the model is going to be this trend, which suggests so you can see what happened during the mid 90s. 95 to 2000, there was a boom in income growth. This was during the stock market boom. And then income growth slowed going into the recession, and then it's picked up more recently. And then real mortgage interest rates actually declined going into, this is the start of the recession. So actually real mortgage interest rates were declining during this period. And so some people have argued that, this decline in mortgage interest rates was a big, this was driving the housing boom. You can see in terms of the quarterly real mortgage interest rate, it only dropped by about 30 basis points prior to the peak in terms of the business cycle. And then it continued to drop thereafter. And so the quantitative impact of this on house prices, as we'll see, is really small in our model. And so we get the conclusion that this is not really an important driver of the housing boom at all. And in fact, if you were to argue that that is the case, in some models it does actually work, then you have to deal with the fact that it continued to decline after the peak. And so if you think, so if it had a big effect here, you can wonder, why did house prices continue to fall dramatically? Why that interest rate kept falling? So we're going to feed those red lines into the data, into the model. And so this is what you get for the reverse engineered shocks. And so on the left side these are the reverse engineered shocks in the rational expectations model. And this is the reverse engineered shocks in the moving average model. Okay, and so let me just kind of take you through this. And then in the blue lines are always the long-term debt model, and the red lines are the one-period mortgage model. So the rational expectations model, the reverse engineered housing preference shock, you basically need a big one. This is, again, the same idea as I showed you before. This model does not produce a lot of volatility in the asset price, and so in order to get the house price to go up and down, you need a big housing preference shock. Whereas this is the housing preference shock that you reverse engineer from the moving average model. It's much smaller, and it's almost basically mean zero over the entire simulation period. And down here on the lower panels are the reverse engineered lending standard shocks that you need to get these models to match the trajectories in the data in terms of mortgage debt to income. So let me just focus on the red lines here, so this is the mortgage. This is the one-period mortgage model. It doesn't really matter whether you're looking at the rational model or the moving average model. What this says is that mortgage lending standard shocks were not important during the boom. And why is that? Well, because when you have one-period mortgage debt, the collateral constraint tightly couples debt to the housing value. And since you're already matching the run-up in housing value with this preference shock, then the mortgage debt just follows right along, and you don't need any action in terms of these lending standard shocks. So according to this model, lending standards were not they're not an important driver of the boom. It was all housing demand. Now, okay, but when house prices fell, these models would also predict a rapid deleveraging, right? Because you can refinance the entire stock of debt every single period with a one-period mortgage. And in the data, as you saw, the deleveraging happened much slower than the drop in house prices. And so in order to get these models to match that feature, they have to predict that lending standards loosened during the recession and stayed looser after, even up until the end of the sample. So that's what this is the increase in the M in that borrowing constraint. So it allows households to borrow more for any given housing equity. So we're going to show that that's counterfactual. Whereas the long-term mortgages have kind of what we think is the more plausible and conventional story about the boom and bust, is that lending standards in terms of this M variable are going up, in terms of you can borrow higher fraction of your equity during the boom, and then they started to tighten even before the recession started, and then they remain tight. Lending standards remain tighter during the recovery and remain tight, until our end of our sample. And so this is some evidence on that regard. So this is the SLUICE data, the so-called Senior Loan Officer Opinion Survey that the board puts out. It's the fraction of banks that are tightening lending standards, and this is the case for residential mortgage and credit cards. And you can see, during the boom, these are in the negative territory, and which suggests that banks were loosening lending standards. They started to tighten lending standards before the recession started, and then even after the recession ended in 2009 Q2, which is about here, there's still a substantial fraction of banks that are tightening lending standards, which matches the pattern that comes out of the long-term mortgage models. This just compares this is the quantitative comparison of the shocks. Again, the moving average models have much smaller mean housing preference shock relative to the rational expectations model. So now let's look at the implications for some variables that we didn't try to match exactly. Remember, the rent is the housing service flow plus the marginal collateral value of the house for borrowing. This is what would happen in the data. Basically, on this scale, it basically looks like nothing happened at all in terms of it's just flat. There is a tiny decline in here. And this is what the rational expectations models predict. Because of that big housing preference shock that you have here, you get this boom-bust cycle in rent to income, which is extremely counterfactual. Whereas the moving average model, since they generate this excess volatility via the expectations mechanism, they don't need to have such a big housing demand shock. And then this is the implications for the consumption to income ratio. So the black is the data. And again, in this case, all of the models have the same prediction by construction, because this simple household budget constraint shows that the consumption income ratio can only move around due to changes in the debt to income ratio or changes in the mortgage interest rate. And those are the same for all the models by construction. And so the pattern that comes out of the models is the blue, and then we have a smooth version of that, and it has a hump-shaped pattern. It's obviously more volatile than the data, but in a qualitative sense, it captures the idea of a consumption boom and a consumption bust, and then actually even a sluggish recovery. And that's what we show here, is that if you calculate the consumption growth coming out of the model, you get the idea that there was a consumption boom, there was a consumption drop during the recession, and then in the recovery period, you have the growth of consumption is slower than it was during the boom. That's because households are deleveraging. And then we also, this last part of the paper, we do this counterfactual exercises where we have, for each model, we have these 4 shocks. 2 of them are identified from the data, and 2 are reverse engineered. And so what we can do is we can shut off a shock and see what happens relative to the data, and see how important that shock was. And it's a little bit hard to interpret these pictures because in each case you're shutting off a shock that's different across the 4 models, and then the shocks that are remaining are also different across the 4 models. But let me just as an example. So remember, this is the data in terms of housing value to income, and this is mortgage debt to income. So if all the 4 shocks were turned on, every single model would basically follow that path. So now we're going to turn off the housing preference shock, and you're going to see what happens in each of the models. And so in the rational expectations models here, you get no boom at all in house prices or housing value. So that just shows you that the preference shock is doing all the heavy lifting in that model for behavior of housing value. Whereas in the moving average model, you still get a boom and you get a bust, but it's not as big. Again, but the shock that you're turning off is much smaller than in the prior case, which suggests that the other 3 shocks are actually doing some work in that model. And then the other thing, if you look at over here, the 1-period mortgage models, which are the green and the gray here, because there's no housing, when you turn off the housing preference shock, you don't get much of a run-up in debt. That's because with the 1-period mortgages, the debt and the housing value are tightly coupled, and so there's no need to have the lending standard shock doing anything in this case. And then let me just jump to the last one, which is the mortgage interest rate. And this is a case where we shut off the mortgage interest rate shock. And so again, this is this, getting back to the story, like John Taylor said, well, Fed's interest rate too low for too long, and that was really the cause of the boom. And so in this case, we turn off the mortgage interest rate shock, and basically you don't get much change in any of the trajectories of all four models, which suggests that, at least in our framework, that was not an important driver of the boom bust, either for housing value or for mortgage debt. Okay, so yeah, I think so. Basically, what I think this is, if you look at the literature, there's a lot of DSG models that are introducing these housing demand shocks as a way to match the data in terms of volatility. But they never really look at what the implications are for other things like the rent-to-income ratio, which, as we saw, did not really move around at all. And then the one-period mortgage debt models, which are also typically used in DSG models, those predict this tight coupling between housing value and mortgage debt, which again is something you also don't see in the data. You see a slow deleveraging, whereas you saw a rapid drop in housing values. And then, again, we don't really get the idea that mortgage interest rates were that important in terms of driving this episode, mainly because they weren't quantitatively big in terms of the amount of basis point drop in that mortgage interest rate was really not that large going into the peak. And then, so anyways, our story comes down on the idea that there was a bubble component to the story in the sense that there was overshooting relative to what a rational model would predict. And that can be rationalized via, explained via this idea that moving average forecast rules introduce excess volatility, which is supported by the survey data. And we think this modeling technique of using long-term mortgages is also helpful in getting a model to match those quantitative features. So I'll stop there.